day traders, and welcome to the premium video newsletter for Friday, August 9, 2013. Today, since it's Friday, instead of our usual analysis, I'm going to go through some technical levels for different markets and sectors that I have my eye on, so you can see how I analyze markets before I get into trade setups. One thing I noticed with many beginners is they start out with daily charts, and that's okay if you're day trading. But if you're holding positions overnight, you may want to start off with a longer or broader view. I find that when I start off with a broader or longer term view, I get a better perspective on markets that I'm analyzing for the short term. In addition, when you're looking at markets from a longer term view, you get to see how the fundamentals are truly affecting the market that you're trading. So that's the other benefit of longer term analysis. Starting off with the bond market, you can see how different it looks when looking at the weekly chart. The market is right now actually very high compared to how it looks on the daily chart. If you recall, I'm bearish long term on this market because yield on interest rates will go up. It's not a question if, but a question when. And nothing will make rates go higher than Feds coming closer to stopping the stimuli program. And as soon as there's some certainty to this, we will go down and break the current long-term support levels, which right now is just a hair below our current level. If we break the 124 level, I think we will really start moving downwards at a more rapid pace. The only question now is when the Feds will really start tapering. I'm only taking short positions in this market, and I'm recommending you do the same just as well. The next market I want to take a look at is the gold market. This is another market that's been rallying since the early 2000s, and it looks like we broke the long-term trend right around the beginning of this year. The gold market moves higher when US and global economy have strong uncertainty. And if you recall, the Iraq war was the big catalyst for this market, as well as the oil market. Right now, things are settling back down in the big scheme of things, and US economy is once again looking forward to coming out of the mortgage crisis, and jobs are improving. It looks like gold is definitely on a downslide, and I'm anticipating us going back to the triple digits. As long as the fundamentals keep improving, and US stock market is fairly close to the highs, I am anticipating weaker gold prices for the remainder of this year and into the next year. I'm only taking bearish positions in this market and suggest you fade the rallies, as I have been doing successfully for the last several months. The next sector I want to look at is the S&P Homebuilders sector. This is another sector that was beaten down strongly several years back and has been doing a great job coming back during the last 2 years. Remember what I always say, the longer the market trends, the longer it will consolidate, and the longer the market is range bound, the better the trend coming out of this consolidation area will be. My take on this market is simple. The rally we saw over the last 2 years was necessary because the sector was oversold, as oversold can get. And we saw 16 straight months of earning growth in this industry. But now we are at reasonably high levels. The current economic climate will come into play, and we will begin seeing faster cycling between the trend and the range-bound trading action. It appears that we are once again entering a range-bound cycle, and this makes sense because there's a lot of uncertainty surrounding the Feds at this time. But I'm still bullish in this sector, and I'm only taking trades to the upside. And by the way, I'm looking at several individual home builders because I do believe this sector will become a stronger sector with time. This is not a short-term trade idea, but a longer one. If you have interest in home builder stocks that may increase over 100% over the next 2 years, send me a quick email and I'll provide you with the strongest stocks in the group. This is definitely a sector you want to keep your eye on. The next market I'd like to discuss is the energy market. If you look at the weekly chart for the last 3 to 4 years, you will see mostly a range-bound cycle, moving between the 108 and the 76 area. But if you look back further, you will see that this market has been rallying strongly for almost 10 years straight. Remember the golden rule: the longer the trend, the longer the consolidation. So I'm not surprised at the length of the current cycle. Right now, I do believe the fundamentals are changing, and I do think we will continue seeing more range-bound action for the next several months till we have substantial certainty that the US economy is gaining stability, and I mean real stability. This means no more war or issues with the Middle East. And I do think we're getting there, but it's taking time, and it'll take more time. I'm positive that we will start seeing lower prices, and once we do, the price should subside substantially and quicker. But we're simply not there just yet. The next market I want to go through is the Japanese yen, and I look at currencies primarily based on technical factors. As you can see, the market has been range-bound for over 3 years before breaking out higher. But right now, the long-term trend is clearly down. And this is one of the reasons why I'm so cautious with taking positions to the long side. If you were to trade off this chart, you would think the market is moving straight down. Now take a look at the daily chart of the yen. It looks totally different, and I'm not that happy about that. Let me explain. I typically like the weekly charts and the daily charts to move in the same direction. But the daily chart is really beginning to break out to the upside. And this is why I'm so cautious. And this is why I'm telling you to keep your eye on the support line in this market. Because if it breaks it, well, it can go down a lot more. According to the weekly chart, this market can go to the 85 level in a heartbeat. So we have to be very careful when taking trades in the yen right now. I've been talking about the yen so much and warning you about the support line. But I realized that till today, I never went over the weekly chart. So I'm glad you're seeing it from the same perspective as me today. Be very cautious because the weekly chart is pointing down and the daily chart is pointing up. What I want you to get out of today's tutorial is that you need to keep your eye on the weekly charts before analyzing the daily charts. I do this all the time, even though I don't show it to you in the daily tutorials because it would just take too long. But I always start with a longer term view and work down from there, and I recommend you do the same. It will improve your trading and make you see the markets from a whole new perspective. That's it for today, and I hope you have a wonderful weekend. I will update you Sunday.